Hey everybody, welcome back to Young Bucks. Great show for you this week. We're going to talk a lot about earnings because it's earnings season. We talked about that a little bit last week, but go back, watch the pizza review, all that good stuff. We're talking about earnings, looking at a couple companies that Narwhal holds for clients, talking about that. Also talking about performance fees and a huge announcement coming out of Narwhal Capital Management about performance fees. Thanks for being here. Hey everyone, we'll get to the What the Buck segment in just a minute, but first I want to talk to you all about two really important things: the economy and millennials. Now, most of you viewing are millennials if we trust the Google Analytics out there, and that means you probably don't understand that the economy is important. Luckily for you, there's a resource that you can access for totally free to learn about the economy. It's right on our YouTube page, youtube.com/Tusk Media LLC. Now, it's about 30 or 40 minutes long. Ben and myself, we talk all about this thing called the economy. What's going well, what's going poorly, what's working, what's not working, and what we expect in the months to come. If I believe the stereotypes, you will not have the attention span to watch the whole video. But if I also believe the stereotypes, none of you work very hard. So while you're at work, go to youtube.com/Tusk Media LLC. We have our quarterly macro presentation right there. You can check it out. There's a lot of stuff. There's things called charts on there, which show things. That's a line. There's some other charts that look differently. There's one that's kind of curvy. So all kinds of different shapes would be a great chance for you to kind of refresh some geometry as well. So check that out. The Narwhal Capital Management quarterly macro webinar. It's live, it's electric. We appreciate you being here. Hit subscribe, download, delete, re-download, all that good stuff. Thanks. Hey everybody, welcome back to What the Buck, the segment when we talk about money and we talk about football. Andrew Hall here, joined by Ben Nye, Matt Krebsbach, and Sam Frost over here doing his homework last minute. Jumping right in. First topic we got is fees and investment management, and in particular, we want to talk about performance fees. So for those out there who might be a little bit uninitiated, that's probably a good thing if you're not terribly familiar with the performance fees. So hopefully that means you're not paying one. So long story short, there's a couple of different ways that you can bill a client for services. Our firm, Narwhal Capital, happens to be kind of a traditional percentage of assets. So maybe you give us $1 million to manage, we charge you 1%. That means over the course of the year, we just pull out about 1%, right at it actually. So maybe it's 25 basis points a quarter, so 0.25% of your assets. That's how we do it. Other places might have that and commissions, things like that strapped in, and then also you have the famous performance fee, which you especially see typically associated with hedge funds. So a lot of times you'll hear about like a 2 and 20 fee. That means you pay them 2% to manage your money and then 20% of gains or 20% of gains above a certain amount. So performance fees are out there. It's kind of an interesting word because it's associated with performance, but also it tends to hurt performance. If you make $100, but I keep 20% of that, you really only made 80. So basic example there. But Ben, I want to get your thoughts and talk specifically about a recent example of, I guess, some performance fee manipulation almost.
Yeah, well, I would stay tuned for the call out segment today because we go into that in a great deal of depth. But to kind of give you a little bit of a preview, essentially a performance fee you generally don't charge above a certain high water mark. So if you reached $1 million and then you pulled back 10% in that year and now you're at 900,000, all those gains back to $1 million you wouldn't have to pay a performance fee on. And then once you hit $1 million again, then all the gains above that you'd start to have performance charge. Well, this guy says, okay, well, you can now invest more money if you've pulled back 10%, you're 900,000, you can invest more money and you don't have to pay a performance fee until you recover those losses. So you're up 11% is how the math works. So that's kind of what these guys did. And again, we'll explain more of it toward the end of this episode. But to my mind, I think performance fees make intuitive sense. I mean, you are rewarding your manager for the job that they do. The problem is it doesn't work in reverse. If performance fees worked in reverse so that they would have to pay you 20% of anything that they lost, then all of a sudden they have skin in the game. The problem with performance fees is that they don't have skin in the game. They make hay while the sun is shining, and when it's not shining, they'll foot you with the bill. So I think that's the issue with performance fees that I have.
Yeah, and it kind of becomes, I'll pass it to you 1 second, but it becomes imbalanced because it encourages me to take risk because, let's say I could, use a really extreme example, but I'm buying $1 million worth of something. If it goes to 2 million, I'm going to get a huge fat performance fee. If it goes to 0, guess what? It's not like I'm paying you anything. So it really incentivizes sometimes managers to take undue concentrated risks.
And the other thing to keep in mind, I don't know if y'all mentioned this yet, but the old school hedge fund model was the 2 and 20 rule, which was 2% on just assets under management, and then 20% would be charged on the returns above the high water mark that the manager gets. So if a manager comes out and cuts the performance fee, but they're under the high water mark, then yeah, that's all fine and dandy saying, hey, we're not going to charge you a performance fee, but they're still collecting 2% of assets. And so they're still getting paid. It's not like they're saying, coming out and being like all humble and be like, hey, like, we're really sorry that, last year was a bad quarter. We're just going to manage your money for free until we get back above that high water mark. They're saying you're still going to keep paying us a lot of money, but we're going to cut back, a little bit on the fees that we're charging.
Yeah, and along those lines, we'll wrap it up here, but we're really excited to break this news here on the podcast for Young Bucks. But Narwhal Capital Management, which is, the parent company of Tusk Media, has decided to officially do away with, for calendar year 2017, performance fees. So shout out to the clients out there. No performance fees this year. There weren't any last year. There haven't been any throughout the...
I was going to say, that's retroactive, right?
Yeah, we're going to go ahead and apply that back. There's no performance fees on asset management. So really excited to announce that. It's going to feel a lot like 05, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, and now 2017. So really excited. Great news. Now, obviously, if you've signed an agreement with us, you know that we can't charge them to begin with, but really excited to be rolling those fees back. Earnings, we talked a lot about earnings last week, ate a lot of pizza, did all that good stuff, drank a margarita. It's kind of what you have to do during earnings season just to stay sane, but going to highlight a couple companies. I'm going to start with you, Sam, while we're on the topic of food and earnings. Del Taco, ticker TACO, TACO. A position I think you and I own in our personal accounts. I don't think any clients own it. Correct me if I'm wrong.
Yeah, we have one account.
Shout out to that one.
Yeah, sorry for that one account. But so no, Del Taco, good company. They basically are like in between Taco Bell and Chipotle. And that's kind of what they're pitching themselves on, is this QSR plus, the quick service restaurant plus. So it's not quite McDonald's or quite Taco Bell, but it's also not quite like a Panera, who's like considered fast casual. It's right there in the middle. And so I think it's a good position to be in. But they come out, they've just quarter after quarter, they do really well. They've only been public for, about 2 years or so. They come out quarter after quarter with strong results. And then this quarter we were looking at thinking they were going to beat on earnings, beat on revenue. Well, they come out, they do beat analyst estimates on revenue. They come out at about 111 million. Estimates were 110 million for revenue. They meet on EPS. So I believe it was 13 cents a share is what analysts were expecting. So that's great. And then you see this all the time with companies during an earnings report, is that it's almost all reliant on guidance. So if you have a bad quarter, but you raise your guidance and say we're going to do really well for the rest of the year, then people will buy the share up. They'll buy those shares. But the opposite is true, is if you lower guidance, then a lot of times the market will punish you. And that's kind of what happened to Del Taco. They didn't lower guidance. They narrowed the range of their guidance, which I don't think was really bad. I thought they had a really good quarter. They come out, they're lapping one of their most successful quarters a year ago when they launched their main product, the Del Taco. And
Del.
Yeah, and so I thought they did really good. They posted, positive same-store sales comps. I believe this is the 17th quarter in a row or something like that. Just strong performance year after year. They've gotten hammered. They went down 20% after the earnings call, which is tough. I think that's overdone, but you've seen the last couple of days since the earnings, it's like somebody buys them up. They've opened up like 2% every day since, and then at the end of the day, they're roughly flat. It's like the market just keeps pushing them to about $12.50 a share. I guess the market's just waiting to hear a little bit more news before they start buying them up again.
There we go. And two more companies we're going to hit on today: American Express, IBM, positions that are little bit more widely held across Narwhal portfolios. Ben, what are your thoughts? You can lead off with either one or both, whatever you want to do.
Yeah, well, let's start off with IBM. By the way, before I get into this, if you haven't tried Del Taco, I would highly recommend it. In fact, go to Del Taco and buy everything you can eat, and then more, and then go to another Del Taco and do the same thing, because we need to get that revenue up.
And point of
especially
note,
for me and Sam's portfolios.
they just launched queso, and their queso is supposedly much better than Chipotle's.
So buy all of it.
That's not saying much, though.
Yeah, it's a low bar.
So let's start with IBM. I think, Sam, you mentioned 17 straight quarters of positive revenue growth. And if you flip that, let's talk about IBM, which just reported its 22nd quarter in a row of revenue declines. Big Blue is, in the big red right now. But it's all an expectations game when we're talking about earnings. If people expect IBM to lose revenue, then it's not going to be a shock when that happens, and you're not going to see the stock probably go down as much. In fact, what happened is IBM actually lost less revenue than people thought it was going to this year, and sales were a little stronger than people expected. As a result, the stock really flew. I think it approached 160. It might still be around there. And the reason for this was because they just came out with a new mainframe, which is a high functioning computer. It's called the Z14. That's really boosting sales. And importantly, a lot of times what IBM does is they kind of juice revenue and juice growth by buying other businesses or fudging with the accounting. This time there was an absence of that. Organic growth, which means what IBM is doing exclusive of things like acquisitions, was a lot stronger than I had expected and what it has been over the past number of quarters. And as a result, IBM's shares did really well. This isn't to say IBM is the next Microsoft, but it is to say that they now have this big product, the Z14 mainframe, and it's subsidizing the cost of new growth in areas like blockchain and software and cloud computing. So
I think it's very easy for them to move around that revenue in different segments. Like they have certain segments that are just like dying, like negative 10% quarter over quarter, and then other, their strategic stuff and their cloud stuff that's up 15. I mean, I think it's super easy to move stuff around to make it look like it's this growth company now.
Yeah.
But
it's a bizarre company. You know how most companies,
it's complicated.
If Narwhal were to do financial statements and announce them publicly, we'd probably have Core Asset Management, Tusk Media, and things like that. Instead, what IBM does is they group these random businesses and call them strategic imperatives, and that is the business segment. I don't know how it's managed or whatever, but they call that group, the business segment, strategic imperatives.
And it makes the analysis really hard when you have that much stuff to look at. Like, they can hide so much stuff if they want to hide so much stuff. Like GE, you're pretty much seeing that. I don't want to get into GE, but you're kind of seeing just a lot of cockroaches that, as an analyst from the outside, you just can't find.
Yeah. Unfortunately, I've been finding way too many cockroaches in my apartment lately. Sounds
like a personal problem.
On the American Express side, so moving from IBM to American Express, everyone knows they lost the Costco contract. This is why you can't use your Amex card at Costco anymore. So there's a big shift in that credit card base. And what they're doing is they're cycling over it now. So you're seeing a maturation of these new consumers who are of inferior quality to the elites, the Costco customers. And as a result, you're starting to see that loss rate and the delinquency rate tick up a little bit for Amex. Personally, I don't think this is a big deal for them. That's opinion, not fact. I think that they're actually executing to the plan pretty well. They raised guidance. That guidance raise was fairly expected, but I expect that the momentum is going to continue into 2018 as long as the macro space in the United States remains strong. Interestingly, when we talk about Amex, a big portion of their income comes from international, which I think a lot of people forget because, it does have America in its name.
It's a great point.
I'll just say my issue with American Express is that, like you said, now they're going after the lower tier people or customers.
Like me, I now have an Amex card.
I have 4. But because
Not kidding, folks.
I'm not kidding. So that kind of changes your portfolio like risk characteristics. Like you said, the charge-offs are going up. So I think that the argument that American Express deserves this premium over other card issuers is less than it was before, in my opinion. And a lot of those new customers they carry balances. They're not charge cards. So American Express is now carrying that risk of being repaid, where before it was more just like 1 month, because charge cards are different because you have to pay that off in the month. Credit cards, you can carry that over as long as you want.
Right.
So it changes the risk profile, in my opinion.
There we go. Interesting earnings updates. We'll have tons of earnings coming in the next couple weeks still. Everybody's here for football. Let's talk football. Current standings in the college football pick'em contest. This is against the spread. Ben is in first at 22-13. Garrett, Barrett, and Jarrett are tied for second at 21-14. Me and Krebs are sitting at 20-15, and Sam at 18-17. Everybody above 500, which is pretty ridiculous. Games this week: Georgia, 14-point favorite against Florida, big rivalry game. I think Georgia's just going to stomp them. Everybody's nervous about it. I'm not. So I got the Dogs -14.
I got Georgia.
Florida winning.
Wow, big.
I have UGA.
If they win if UGA wins by 10, you can count that as a loss. I mean, they're going to win.
They're going to win by 14.
Just kidding.
At least.
No.
Wisconsin, a 26-point favorite against Illinois. Is Illinois ranked?
No.
Got 'em.
I mean, Illinois is a dumpster of a football team. They're never good. Playing at Illinois isn't that hard of a road game. I think Wisconsin's going to cover that handily. I think it'll be like 38-7 or something.
I'm going to keep betting against Wisconsin and keep losing. I'm going with Illinois.
I got Illinois.
I have Wisconsin.
All right. Washington trying to get some momentum back. 17-point favorite against UCLA. Ben, talk to us.
I think Washington's going to come out strong. I'm actually going to be at the game, so I'll document
Big.
it. So
Huge.
make sure you're following us on Twitter. I'll also recap the game probably the following week. Maybe
Whole
some,
episode.
Yeah, maybe some good video clips
If
too.
you can hear anything.
Yeah, it's going to be loud. Probably like 5 people in the stadium or something.
Maybe
But
500,000.
But I have UCLA. I think Washington will win it, but our defense is just too good. But we're just going to continue to fight offensive jitters, I think.
Bama is off this week. Bonus game we got is Ohio State, 6.5-point favorite against Penn State. I'm not a big believer in Penn State. Apparently other people aren't either. They're ranked higher and have a better record than Ohio State, and yet they're 6.5-point underdog. I'm going with Ohio State covering that, even though that seems like a pretty big spread.
I mean, with Penn State looked great against Michigan. I don't know if that's Penn State being a lot better than I thought it was, or Michigan being a lot worse. But even so, I think 6.5 is quite a bit. I think should be a close game.
Hope so.
So I take Penn State.
The
spread's too big.
I actually have Penn State because I think if Ohio State wins, they'll cover the spread easy. I don't think they're going to win by 3 points, but I think Penn State actually has a better shot at winning that game.
Man,
So I got Penn State.
bet that money line, dude. Get some money.
Ohio State.
All right. There we go. We'll find out next week how it goes. Stay tuned. Thanks for being here. Hit subscribe. Check us out on iTunes. Leave us a 5-star review. We'll read those on air at a later date. Lots of good stuff coming. Got some conferences we'll be doing some live coverage of, things like that. So y'all stay tuned. We'll talk to you soon.
Hi, my name is Ben Nye, and this is The Call Out. Today we're talking about a Wall Street Journal article that came out on October the 19th. Its title is Hedge Fund Maverick Capital Debuts 0% Performance Fees. Now, this Wall Street Journal article goes into a lot of great depth talking about how fees in the hedge fund space are compressing because the returns in the hedge fund space have been weak, especially over the last 5 years. And the poster child for this is Maverick Capital. Maverick Capital manages about $10 billion in assets, so it's a successful fund. It's based in Manhattan. And they had their quarterly investment meeting a few weeks ago. Now, at this meeting, the owner, Lee Ansley, he said that he is going to debut a new class of shares. So when you invest in a hedge fund, you buy a share in that hedge fund. And usually those shares pay a fee. And the fee is going to be about 1% or 2% of the total assets that you invest. And then on top of that, whatever return occurs, you have to pay a percentage of that to the fund as well. It's a way to incentivize the manager to perform well, so he does well and you do well. This tends to work pretty well, except when the manager is underperforming, obviously, because they reach a point where they don't actually have to pay you when they underperform. They just don't receive any performance fees. You still have to pay the management fee. This new class of shares that Ansley has debuted carry a 1% management fee. So if you invest $1 million, you have to pay $10,000 a year in your management fee. And you don't have a performance fee. But here's the catch. In order to be eligible to buy those shares, you have to already be an investor in the fund. Moreover, once you recoup the losses that you have had, that performance fee gets canceled, and now you have to pay the regular performance fee. This is called the high water mark. The only difference in this new strategy that Ansley is coming out with is that you can actually invest more money and not have to pay a performance fee until it gets to the high water mark. Usually, if you invested more money, you'd have to pay a performance fee on that portion of your newly invested money, while the existing portion didn't have to pay a performance fee. So the Wall Street Journal talks about how this is a symptom of the fee compression. But I would say it's a symptom of the return compression in the industry. So the reason that Maverick Capital is forced to charge lower fees now is because they have performed extremely poorly over the last 5 years. Over the last 5 years, Maverick has returned 8.7% per year, according to their 2016 letter, and the S&P 500 has returned 14.6%. This means that if you invested $1 million, let's say $1 million, net of fees, you would have made $87,000 a year with Maverick versus $146,000 a year just investing in the S&P 500 index fund. So you're losing about $60,000 every single year. So over the course of 5 years, that's going to translate to more than $300,000 that you're behind. That's real money if you've invested $1 million to begin with. So that's number one. Number two is that in the last year, in 2016 itself, Maverick actually lost you money. Maverick net of fees was down 10.6%. The S&P 500 was up 12%. This is underperformance of 22%. If you started with $1 million, you're down to about $900,000, where if you did the S&P 500 index fund, you'd have over $1.1 million. That's a $200,000 differential. And 2017 isn't much better. According to the same Wall Street Journal article, Maverick has been down 2%, and the S&P 500 is up 14%. Again, a 16% differential. That's $160,000 on that $1 million. And then the Wall Street Journal article goes on to talk about how this year is actually a better year for hedge funds, and they're actually doing the best they have in a long time. They are up 9.6% on average. According to the Wall Street Journal, these stock funds are up 9.6% at the end of September. At the end of September, the S&P 500 was up 14%. Again, this is underperformance of about 5%. And I get that hedge funds are not going to be fully invested in the market and they should have better downside protection. But when you underperform by 5, 10, 15%, 20% year after year after year, that's going to add up. And I don't care if you only lose 20% instead of 30%, or in Maverick's case, 27% instead of 37% in 2008. That's going to be extremely difficult to catch up from when you're underperforming serially by 10 to 15% a year. I mean, that's going to be extremely difficult to catch up. And this is a reason that passive investing has been performing so well. So the fact of the matter is that there is a place for hedge funds. Hedge funds are an alternative asset class, but they have been underperforming dramatically over the last number of years. They're being forced to lower fees or feel compelled to lower fees because of a sense of duty, which I respect, but it also is a sign that, they have not been performing well and they continue to underperform. And if you're invested in a hedge fund, I would recommend you asking them about lowering their fees, because there isn't a reason you should pay such a high fee for such poor performance. That's it for the call out. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.